Hey there, everyone, and welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at Stockcharts.com in a sunny Redmond, Washington. Happy Wednesday, happy Fed Day. A lot to talk about, although it was sort of much ado about nothing in terms of the specifics from the Fed. I would say no huge things that we learned on top of what we had known up until now, but the market's certainly taking it as a vote of confidence. There wasn't any sort of negativity, any sort of implication of hiking rates at any time soon as a result. Risk assets pushing to the upside, stocks higher, gold higher, Bitcoin higher, not just risk assets, a little of everything sort of pushing to the upside. So nice sort of upside resolution through the course of the day today. I would say tomorrow, once you sort of come off of this delicious meal we've had of a bright rally on Fed Day on Wednesday, what happens Thursday and Friday? We got a lot of earnings through the remainder of this week, stocks like Lululemon, Nike, and others. For now, though, let's pay attention to how the markets evolve through the course of the day today as the S&P closing above 5,200 for the first time. Let's get right to our market recap. Before we get into the charts and how they played out today on Fed Day, let's answer the poll question we asked you. Do you think the S&P 500 will retest its October 22 low, which is around 3,500 in 2024? Simple question, yes or no. Almost 3 out of every 4 of you said, no way we hit that October 22 low. Let's actually look at the weekly chart of the S&P 500. My market trend model chart's usually the way that I kind of do this. So going out of the 2022 low, that's around here, right? That's the October low, and this is the SPY, so we can say SPX, just so we're looking at the same level. So we're kind of talking about going back down to this swing low in October. That's a long way away, and of course we asked this on a day when we're going up to a Fed announcement. Big win for the markets, closing to new all-time highs yet again today. So overall, only 30% of you saying, yeah, we're going to get below there. I would probably say no, to be honest with you. Is it? But here's the thing to remember. Is it possible? It absolutely is. And that's what you have to remember. Over the course of like an 8 or 9 month period, a lot of things could happen. But what you have to remember, there are some plausible scenarios, some likely scenarios, and then there are unlikely but possible. And I would encourage you, don't right away, don't write off those unlikely scenarios that are still possible. A lot of times we're caught off guard because the markets, if you read up on market history, you will learn from a statistical perspective, the markets don't follow a normal distribution, right? Meaning a normal distribution means 2-3 standard deviation events should happen very rarely, like less than 1% of the time. Those things happen a lot more often in the financial markets. That's what they call the fat tails, right? Those higher likelihood of big out of sample scenario. So don't forget to think about that disaster scenario, that uber bullish scenario. Think about what that might mean to your portfolio. How would you manage risk and find opportunities if those different environments play out? And then regardless, whatever happens, at least you've thought through it once ahead of time. So thanks for answering that poll question. Don't forget to follow us on all the socials so you won't miss on the next poll. Continuing here in our market recap, nice upswing through the course of the day, leading into today's Fed meeting, or the Fed announcement at 2 p.m. and the press conference here at 2:30. Basically flat low volume, which is pretty common on a Fed day leading up to that big announcement. From there, it was pretty much a resounding upswing, an initial rally. And I mean, this is one of those kind of head scratcher thing. Like, I don't know if the market would be thinking, if anyone would be thinking the Fed would be doing anything other than keeping the rates the same, although the language did change slightly, of course, in their official statement. But it was more about the press conference where you saw the nice rally going into the close. The S&P closing above 5,200 for the first time and actually finished above 5,200, closing almost 1% higher, about 0.9% higher to 5,224 and change. The NASDAQ composite even better, going up 1.25%. Mid caps and small caps all up as well. The S&P 600 small cap index, which was basically flat up until 2 p.m. Eastern, bounced higher 1.7% to be the best performer of those three particular indexes. The only red on our front page is the VIX. The VIX remains in a low volatility range. Anything below 15 I would generally describe as low volatility. And all that means is usually happens when the market's going higher, and it tells you the market's going higher and there's not a lot of volatility, even though today is certainly a big move in the last hour and a half. But overall, the traditional measure of volatility, looking at the options market, pretty muted. And so the VIX down around 13 basically tells you slow and steady uptrend continues to be playing out, I guess, as expected. Now, interest rates chopped around quite a bit. There's a lot of movement. Now, of course, when we're hearing from the Fed, we're thinking a lot about interest rate policy. what sort of changes they might make, and no changes today, but more about the trajectory, right? The pace of potential rate cuts through the remainder of this year and into next year. Sort of reinforce that idea. A couple cuts in 2024. They were not specific about when that first cut might come, but it was more about let's line it up with the data, what they call data-dependent sort of approach, and that just means we'll wait and see how things play out between now and the next meeting. It's a fancy way of saying just that. So what happened was the Fed announcement came out. Bonds had come off a bit. The rates immediately popped higher as bonds sold off, but then at 2:30 you saw a complete reversal, and up until around 3 p.m. Eastern, when bonds stopped trading, you actually saw bonds rally pretty good, which puts rates back a little bit lower. So the 10-year yield slightly lower, around 4.27. The 5-year yield a little bit below that, around 4.24, and the long bond yield just below 4.5%. The dollar ended up down about 0.5% from yesterday's close. Looking at the commodity space, some interesting moves, particularly in the precious metals, gold and silver. So, after 2 p.m. when stocks are rallying, gold rallying as well. And this is one of those great days to just remind us. A lot of people still, I think of this, traditional relationship or this perceived relationship that stocks go up, gold goes down, stocks go down, gold goes up. This is that sort of safe haven idea, right? That gold is has an opposite or an inverse correlation to stocks. And so when stocks start going down, gold is probably going up. This is one of those days that happen way more often than you probably think. I would say it's often probably evenly split between gold and stocks moving together and then moving inversely. The correlation between stocks and gold actually is very fluid. It's not as static as I think many of us probably want to believe. So today, stocks breaking higher, gold breaking higher as well. The GLD finished up about 1.2%. Silver prices up over 2% using the SLV. Copper prices moving higher as well. The red you see on the commodity line is looking at the energy space with crude oil prices coming off. The USO is down about 1.5%. We finally have cryptocurrencies back in the green. Bitcoin, Ethereum, both up about 7 to 8%. Bitcoin is right around 66,400. Ether price is just above 3,400. Of course, these are trading 24 hours and even over the weekend. So we're just kind of taking a snapshot here. But you can see just in the last 24, 48 hours, this clear rotation. Bitcoin has been not in a free fall, but certainly in a distribution pattern. Peaked up in the mid 70,000s and all of a sudden coming down to almost 60,000, and actually hit a low earlier today around 61,000, but rallying now right around 66,500. So a bit of a return to an upswing for Bitcoin. Now that's an interesting one because since the big announcement of the new Bitcoin ETFs, and since there were a bunch of flows into those Bitcoin ETFs, like BITO and GBTC, of course, becoming an ETF from a trust structure. This is the first sort of test of these ETFs with a lot more assets when Bitcoin comes down. They're doing just fine today as we're seeing a bit of an upside reversal here. We'll look at the chart of Bitcoin, time permitting, if we can. Looking at the 11 S&P sectors, you can see consumer discretionary number one. The XLY was up 1.5%. Financials number two, and industrials number three. Those are both up about 1.2%. Communication services, by the way, not too far below at number 4. On the downside, only 2 of the 11 S&P sectors were down today, and not by much. Healthcare stocks down about 0.25%. Energy stocks down about 0.1%. Utilities was up slightly, or were up slightly from yesterday's close. The Magnificent Seven and Friends, as I like to call this group of leading mega cap names. You can see Tesla, the top performer today, up 2.5%, followed by Meta, up 1.9%. You have to remember that Tesla is coming off of a pretty beaten down level, right? So the two outliers compared to the other 6 of these stocks, Tesla and Apple, which have by far been the weakest of the 8. Both of those having a nice bounce today. Apple up on another 1.5%. Microsoft actually the worst performer, but probably arguably one of the better charts. Not to jump around too much, but as you're looking at the chart of Microsoft, not quite making a new 52-week closing high, but very, very close to doing so. And this is one of the charts that we've highlighted recently with this red level, which I would call a line in the sand, right? What's that level that as long as we hold it, the price is okay? And if we would break it, that tells you, regardless of what you want to think about Microsoft, a break of that level tells you something's different, right? There's a change of character of some sort. Well, we've been getting further and further away from that level. We didn't quite make a new all-time high, but very close. And this is in Microsoft, one of the largest names out there, just over a $3 trillion market cap. Just take a step back with me if we could, and let's go to the S&P 500. see how things played out here. Now, Fed Day, of course, being a pretty positive outcome for risk assets, particularly stocks. The S&P and the NASDAQ both pushing higher. The S&P just below 1% to the upside, and that move takes us back above this blue trend line. I feel like my my less and less magical trend lines here that are just getting violated off and on with all of these this price movements. And there are times, honestly, when prices track trend lines very well. I would say July, August, September of last year was one of those times, and it's all right. It seems very easy. Let's wait for the trend line to break. It did. Ended up being just this great buy signal. It's not always that clean, and I don't want to ever imply that it is. Sometimes the markets are messy, and if there's a time in recent history that I would describe the markets as messy, this is probably one of those times. The S&P making a new all-time high today, closing above 5,200 for the first time. That takes us above the high that we established earlier in March. That means these Fibonacci retracements probably no longer super relevant. We probably want to bump them up, but I'll wait to see how things play out. And I think as of right now, I'll probably just take these off to try to clean things up a bit. It's on my own personal to-do list to clean this up. I've got way too many lines happening on the chart, but as I've mentioned many times, I think one of the great benefits of using a platform like Stockcharts consistently is I think of charts as a conversation you have with the market. It's an ongoing conversation. The chart of the S&P 500 is one that I look at multiple times a day. I'm often drawing lines, erasing lines, circling things, moving things around, putting notes on charts that I often don't show on the air, and I would encourage you to do so as well. We're going to do a segment a little later called Banking on Breadth, so I'll save some of the breadth commentary for that, but the short answer is breadth looks pretty good because overall the markets have remained very strong. There's still plenty of stocks making new 52-week highs. Hopefully we'll get to a couple of those, but I want to highlight just first Bitcoin potentially having a nice bounce here. We've always talked about those big round numbers. We didn't quite get down to 60,000. We bottomed out just above there, around 61,000. But zooming out this far, you can see why I keep an eye on these particular levels, because when you get close to that, that's usually when you get some sort of bounce. And for now, about almost a 10% rally off of that level, maybe an 8% rally off of that swing low just in the last 12, 24 hours or so. So a nice bounce so far for Bitcoin. Gold, as I mentioned, having a nice rotation higher. Let me bring up the chart of the GLD. Look at this breakout, right? So this was the previous all-time high for the GLD from 2022. You can see we retested that in 23, and then later in November, December of 23. Again, in January, we pull back. We finally break above there. We highlighted the chart of gold here when it felt like something was different. We're actually making a new swing high. You can see that trend has continued. The GLD back above $200 a share. Spot gold, of course, moving higher, back to overbought conditions. But overall, just reflect on the fact that the momentum overall has been very strong. And that's why I've highlighted this in green, because we're overbought when we rally. We're staying above a 40 level when we pull back. That's a constructive pattern. Let's continue to follow those until proven otherwise. To finish off our market recap, I do want to start with just a thought-provoking chart. This is the ratio of Ford to Tesla, because I saw Tesla was one of the top-performing names in the Magnificent Seven and Friends today. Ford actually not doing too bad as well, and this was one of the biggest gainers of the S&P. So I just did a quick ratio of Ford versus Tesla. On Stockcharts, the way you do that is type the first ticker of the colon and the second ticker. So this line is going up. That means Ford outperforming Tesla. The line is going down, Ford underperforming Tesla, or Tesla outperforming. From the end of November, basically from Thanksgiving to where we're at today, it's been Ford over Tesla, and it has not even been close. Brief period there in the second half of February where that ratio came down, but overall, traditional automaker greater than new EV automaker for sure. And interesting if that ratio would continue. What does that tell you about the upside potential in stocks like Ford and others? Apple, of course, I want to highlight. I'll go back to this chart that we've shared before on my list of these mega cap leadership names. But Apple is an interesting one because it's really bouncing off of the key Fibonacci level. And I like just reinforcing these sorts of examples that really demonstrate why Fibonacci retracements and tools like that can be helpful. I often use this sort of framework when something's had a big move and then it pulls back. And then the question is, where might we find support? So the big move was the low in 23 to July of 23. We pull back to 38.2%. We retest that level, break slightly below the 200-day and that support, but then retest the highs. Now we've rolled over. We test that same level again around 169, and not surprisingly, we're bouncing off of there. So stocks oversold as they're testing an established support level from multiple disciplines, pretty high percentage bounce. And for now, I think that's pretty encouraging. Getting above 180, that's the pivot point that I've highlighted in red. See if you can get above the 200-day moving average as well. I think that's a pretty compelling chart all of a sudden. Just to finish off our market recap, AbbVie is one of those names not going up. I've got a lot of examples of things going up, and for time, I'm not going to get to cruise lines, airlines, home builders, but I see you guys all doing quite well. Paramount up 10%. Nice job today. But I do want to highlight the fact that not everything is going up. And I will tell you, on a day like today, it's always interesting to see what is not working, right? What's diverging from everything else that feels like it's doing just fine. AbbVie is one of those many names that's had this bearish momentum diverge. Just look how the RSI was steadily between like 65 and 70, 85 that is, here in December, January, February, and then all of a sudden we keep making new highs, but the momentum totally shifts, right? Now all of a sudden the RSI as of today's close is below 50 for the first time since Thanksgiving. So a stock like AbbVie, a really good chart until it's not. I think charts like this are innocent until proven guilty. And I think we've started to see an early warning sign with the bearish divergence here. You're now seeing a breakdown in momentum. It's not totally broken, right? So we're still holding an ascending 50-day moving average. The RSI is still above 40, so I don't think this is an end of the world breakdown. But these are the types of stocks, if I hold them in a portfolio, they go on a special watch list that I watch very, very closely. And I clearly defined a risk level or a stop. Make sure I stay true to that. Don't hold on to a name like this too long. That's called endowment bias, and it usually does not help your returns over the long term. That's our market recap, really on Fed Day. So much to talk about. Just wanted to hit on some of the key charts on the move. I think through the remainder of this week, tomorrow we'll continue to digest. And there's always that initial reaction. Certainly risk assets taking this as a pretty bullish press conference from Chairman Powell. We'll see what happens tomorrow with some additional earnings data on Friday as well. And I think between now and the end of this week, pretty important time to see if the S&P, if the NASDAQ are able to sustain these breakouts to new all-time highs. We're going to get to our next segment here in a moment, banking on breadth. Before we get to that, just a quick announcement. Let us know what questions you run into. We appreciate so much your feedback on Stockcharts TV. We're in the process of evolving this channel and what kind of content we're sharing. And we appreciate so much the thoughtful comments and suggestions you've given us. We especially appreciate your questions. Our mailbag will be tapped on Friday's show. We'll do a special all mailbag show. We'd love to answer one of your questions in our next mailbag episode. TheFinalBar@StockCharts.com is our email. Hit us there or just drop a comment below the video that you're watching here on YouTube, and we'll hope to answer your question in our next mailbag show. Let's continue on breaking down these markets activity focused on breadth conditions. Now, when I think about market analysis, sort of three levels to the macro discipline, right? It starts with price. So what we look at with the market trend model, with the daily chart of the S&P 500, all those lines in the sand, that's sort of the high level, top level. Is the market going up or down? And I would always start your analysis there. Below there, it's market breadth, looking at things like percent of stocks that are above their moving averages, bullish percent indexes, which are based on point and figure charts, other sort of measures of participation. What about all the individual names and what are they doing? And then tertiary, or the third one down, would be things like sentiment, survey data, positioning data, volatility data. I think of those as third in importance. So we've covered the price action. Let's go to that next level down and see what we can learn about looking at some of the breadth measures that I like to follow. As a reminder, all the breadth charts that I'm going to show you, two ways you can get to this on our Stockcharts platform, maybe three. The first one would be, and this is probably the easiest one, is go to my, homepage on Stockcharts. So if you go to our main website, click on articles. At the top and in the upper right, you will see my blog called The Mindful Investor. I also wrote a note recently about potential downside risk for the QQQ. So if you click on that article or click on my blog here, you're going to get to the same place. And at the top, there's this gray button that says Live Chart List. This is using basically the common charts that I refer to on the show. Most of them are in that live chart list. So it's a really good place to start charting better if you want to make sense of these markets. The other thing you can do, by the way, is set up the chart pack that I provide to all Stockcharts members for free. So if you go to your dashboard, if you're a member, which you all, of course, should be, you go to the upper right that says chart list, go to the bottom. I need to clean these up at some point, but it's Fed Day. I'm busy. I've got other stuff. But if you go to the bottom, you'll find this gray button that says Manage Chart Packs. Mine's called Dave Keller's Morning Coffee Routine. You can install that for free on your login. You get a whole series of charts, including a breadth chart list. So let's get to the charts here. We're going to go to the first one, which is looking at the advanced decline data. You know, the long story short, as we go through these different pieces of evidence, the breadth overall is very strong. And I think that's an important thing to remember. When I talk about bearish divergences, which we've seen plenty of, including with the QQQ most clearly, when we talk about potential downside risk, which is the article I wrote about on Friday, let's keep in mind, I don't think I've hidden the fact that by definition, the trend overall remains very strong, right? My market trend model is bullish on all time frames. The S&P, if you take a step back, I always say, if I ask my 8-year-old son, Henry, is this thing going up or down? He correctly answers. I've tested it recently. He says that's going up, and he's right. So what would Henry say? Think of that as you're looking at a chart like this, and overall, it's clearly going up. One of the longtime technical analysts that I used to love hearing from, John Mendelson, who had a great career in the industry as a technical analyst, he would always say, I love trends I don't need my glasses to see. He was in his 70s, I think, when he was coming around to see us, and I love that one as well. In either case, the trend is positive. Now, here we're looking at breadth conditions. So let's look at all the companies in the New York Stock Exchange, in the S&P 500, the S&P 400 mid cap, the S&P 600 small cap. Are they also going up? Now, these lines that are all making new 52-week highs again this week tell you that, yes, the NYSE advanced decline line remains quite strong. So those are thousands of companies listed on the New York Stock Exchange, all different sectors and styles represented. The breadth is going up, right? When the market is making new highs and the breadth is not confirming those new highs, that's when it's a question mark. So this is why in early February, there's a bit of a questioning that I remember bringing up on the show, and certainly with my premium members saying, look, the S&P is making a new high, that's good, but the breadth is not quite making a new high yet. You really need to see that confirmed before you get too optimistic, and it certainly followed through, right? Since that point, you finally did get that confirmation where the advanced decline lines were breaking out. So at this point, pretty bullish combination. I would say the S&P's advanced decline line and the mid-cap AD line are all pretty positive as well. They're all above upward sloping 50-day moving averages. That's pretty constructive. The only one that's not super bullish at the moment is the small cap breadth line, and that has been a well discussed and often discussed theme. Earlier this year, we spent a lot of time talking about small caps because sort of at the beginning of the year, you saw small caps come off very quickly. And the question was, is that okay? And the answer is, if it's dominated by mega cap growth, that's actually okay if small caps aren't a part of it. And we're seeing the market continue to make new highs with small caps not really participating. Now, they're not losing ground on an absolute basis to a worrying degree, but they're certainly not participating as much as you'd want. I'm starting to, I think over time, I've sort of thought of that as less and less of a warning sign and more just a way of describing the leadership. And I think the leadership remains very top heavy in this market, with names like Microsoft doing just fine. The McClellan Oscillator, this is not quite updated for today's chart just yet, but based on the data, this is going to bounce higher and have a second day confirmed above the zero line, which means I need to color code it green. It's just kind of slightly green over here on the far right. I probably need to give myself more room on this chart, so I will do it in front of all of us. Here we go. I'm going to add 15 bars on the end. That might be too many. This is a great trick, by the way, on stock charts. If you want a little more space, just do, and I like a little bit of space because it helps you kind of think forward a little bit. And then you can actually do shading and do shapes and things like that. You don't have to just make it so annoyingly right at the end of the chart, but you can actually spread it out a little bit. There we go. I'll tighten that up after the show, but you get the idea. So I think this is now turning back positive. It has been a noisy data series recently. I mean, in general, you want to see consistent signals, and I don't disagree. And looking before 2024, this is one of the better signals through the course of 2023 at helping me identify upswings and downswings, and really when those drawdowns were going to be. That was arguably one of the best tools that I had. In 2024, these red shaded areas, when the McClellan oscillator is below zero, the market really hasn't come down. And again, I think it goes back to the chart we were looking at previously and the strength in the mega cap names. When mega cap names, when growth leadership is so strong, there's such a big weight that even if other things are coming off a bit, the market is still strong enough to continue higher. And that's certainly what I think we're seeing here again through this week. Now, this is looking at the stocks making new 52-week highs and stocks making new 52-week lows for the New York Stock Exchange, for the S&P 500. As you look at today's data, and this actually just was updated for today, so it looks like, 92, almost 20%, we'll call that 18, 19% of the S&P making a new 52-week high just today. Those are bull market numbers, right? When you see that many stocks in the S&P making new 52-week highs all on the same day, the S&P, of course, making a new 52-week high as well, that's pretty constructive. And as we've mentioned, this sort of breadth indicator is negative when there's not a lot of green and a lot more red, and we're certainly not seeing that. And for an example, look back to like August. It's a pretty classic rotation of what it looks like when the market's healthy in an uptrend, when the market starts to top out, and all of a sudden you see the new highs dry up and you see an expansion in new lows. That's what a bearish rotation looks like. We're not seeing anything like that, of course. I just did a webcast earlier this week where I was talking about the 7 steps in a market top checklist. Like what sort of things would I look for? One of those items, I think it was 3 or 4, maybe 5. It might have been 5th was breadth indicators start to confirm a downswing. And again, I don't think, long story short, we're seeing that here yet today. Now, this is an interesting one. We might leave it here, but I do want to point out that the percent of stocks above their key moving averages is a really fascinating chart. I think of this as medium-term breadth and long-term breadth. The McClellan oscillator is a good short-term breadth gauge. That really gives you more price swings and if we're seeing short-term accumulation or distribution and when that might be changing. Here we're looking at the percent of stocks above their 50-day moving average and just looking at the S&P 500 names, you can see that's currently around 79% as of today's close. Here in blue, we're looking at the percent of stocks above their 200-day moving averages, which is around 82%. So here's the S&P, of course, well above its 50-day. And again, most S&P stocks, same thing. And well above its 200-day moving average, which is about 600 points below current levels. You can see that again, most S&P stocks, same thing, right? 4 out of every 5 look very similar to the S&P 500 at this point, meaning they're in a pretty good uptrend. Now, this is the medium-term breadth indicator. You'll notice here at the February pullback, we never got below 50%. That's that horizontal line that I've drawn here. And it's an important level because I found when we break below that, that usually means the top is in and we're rotating lower. We didn't get to that point. And to the contrary, we actually have rallied back above there. Now that what's happening, now I'm seeing more and more stocks breaking out. I'm seeing a bunch of new 52-week highs. Now I'm starting to think, all right, is this more setting us up for one of these contrarian sell signals? When this indicator gets up to 90% during a rally, it often ends up being the end of an upswing. You can see at the July peak, at the February peak last year, 22 or 2 years ago, August 22, that peak, you can see this indicator got up to around 90%. Sorry, I meant the November peak there when I was looking at that point. So if you look, the most recent signal, which is at the end of last year, beginning of January, really did not play out, right? We paused briefly for a couple weeks, but then just continued to the upside. But generally speaking, this getting to 90% is usually a warning sign for me. So I'm wondering if we kind of get back up to that level. That's why I think this might be a key chart to watch. The last one to pay attention to is this one, the percent of stocks above their 200-day. And since mid-November, really coming off of the October market low, this has gone above 50%. And has not looked back. Now, this is what I think of as long-term breadth condition. As long as this remains above 50%, even if we have some choppiness, if we have some noise, overall the conditions are quite strong. And as you can see, we're well above that 50% level. So what we've seen is the short-term breadth has now turned more positive. The medium-term breadth, as measured here, remaining quite strong. The long-term breadth remains overall very constructive. So we have the market trend model firing on all cylinders. The breadth conditions quite strong. Based on any trend following evidence I'm going to show you here, the market conditions remain very, very positive. So I would say innocent until proven guilty. Keep a wary eye on some of these charts and make sure you recognize if and when they change. But for now, for the major benchmarks, still remains quite positive. All right, folks, we got to wrap the show and go right to the 3 in 3, 3 charts in 3 minutes that tell the story of this market environment. Here's chart number 1. In my segment, Banking on Breadth, I love to focus on breadth conditions. And again, that's really just a snapshot into a regular process that I go through. I go through breadth indicators in detail once a week, and I look at that, honestly, pretty much every day, just thinking about what changes in breadth might look like and what sort of things I need to be aware of. I would say the McClellan oscillator pushing back above 0 this week is just a short-term thumbs up. I think there were some warning signs last week brewing. Even though medium-term and long-term trends remain quite strong, starting to see a bit of a pullback in some growth names, starting to see some weakening in breadth in the short term, but overall it's remaining quite positive. As long as this remains above 0, no real issue according to the market breadth indicators. Chart number 2, when we went into breadth indicators in a little more detail, I would say if there was one breadth chart I would follow, it probably would be this one because it's a little more longer term. I'm thinking of my conversation yesterday with Chris Shavako, and if you missed that one, it was awesome. Chris is a thoughtful, really, just a very impressive strategist and money manager with, great deep perspective on market history. And he encouraged me through our conversation, just thinking about longer term trends and how they're changing. The long-term breadth, as I would define with a chart like this, remains quite positive. And so as long as those remain the case, as long as that is the conclusion I would draw, overall, I don't see a reason to be too worried about market downside. Finally, remember, there are always stocks somewhere breaking to new highs and breaking to new lows. We highlighted Abbie in our market recap as a name just starting to rotate lower. Let's talk about a name just starting to rotate higher. Home Depot flashing a pennant pattern. This is called a bullish pennant. What a bullish pennant is when you have a rally and then you have a brief consolidation. You have lower highs and higher lows. In this case, you sort of see a tightening of the range. You might even call this a little symmetrical triangle pattern, usually pennant because it's a pretty short-term time frame. Makes sense. You can see today we've closed out of that pennant. We've broken out to the upside. And what that usually means is the trend leading up to that pennant is most likely going to continue. So a bullish end of the day for Home Depot. Folks, that's a wrap for the show. Thanks so much for joining us every weekday after the close for the final bar. For Stock Charts in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a good night.